All right, Chapter 8, Audit Planning and Analytical Procedures. So, first thing you have to do is that we're going to have to do is to discuss why adequate audit planning is essential. And the book talks about three main reasons for that being true. Number one, the first is to enable the auditor to obtain sufficient, appropriate evidence for the circumstances. And so it's like anything else, I guess, in life. Before you start something, it's always good to plan it out. And here, for an auditor, if you don't do good planning, you may end up not getting enough sufficient, appropriate, relevant evidence to audit, which is required. Number two, to help keep audit costs reasonable. If you don't plan something, it's like building something. Unless you plan out the building of that, whatever it is you're building, more than likely you're going to spend more money than you should. Well, the same concept works here. You're trying to keep the cost reasonable in order to keep the client happy, and so planning it out helps with that process. And last, to avoid misunderstandings with the client. The best way to avoid misunderstandings is to plan it out, tell them in what we call an engagement letter, which is essentially a contract, telling them what you're going to do as part of this audit. And so if you look at figure 8-1, here we have 8 different phases that we go through in planning an audit and designing an audit approach. And as the book points out, the first 7 parts are intended to help the auditor develop the last part, the overall audit strategy and audit program. In this chapter, we're going to talk about the first 4 of these 8 factors. Let's talk about a couple of terms here dealing with risk. The first of those is acceptable audit risk. This is a measure of how willing the auditor is to accept that the financial statements may be materially misstated after the audit is completed and an opinion, unqualified opinion, is rendered. If the risk that they're willing to accept is low, meaning they're not willing to accept a great amount of risk, then they may want to conduct more tests, obtain more evidence. They may just simply decide not to accept the client because who needs the headache? Who needs the potential lawsuit? Inherent risk is a measure of the auditor's assessment of the likelihood that there are material misstatements in an account balance before considering the effectiveness of internal control. And so they use the example that if the auditor concludes that there's a high likelihood of material misstatement in accounts receivable due to changed economic situations, the auditor could conclude that there's an inherent risk that accounts receivable is possibly too high. And so the first part, if you look again at figure 8-1, the first part of planning this audit program and designing an audit approach is determining whether or not to accept the client and then perform initial audit planning. And so when accepting a client, you have to look at really four things when you're talking about audit planning. One includes client acceptance and continuance, but there's three others. You should identify the client's reasons for the audit. You should obtain an understanding with the client, and then develop an overall audit strategy. As far as client acceptance is concerned, depends on whether it's a new client or an existing client. If it's a new client, you may need to do some background work. If they were previously audited, it's the successor auditor, that be you. It's their duty to contact the predecessor auditor. As a matter of fact, it's required in auditing standards that the successor auditor contact the predecessor auditor. The reason for this contact is to do background work to determine whether or not they want to accept the engagement, to understand why there's a change in auditors, whether or not there was conflict between the prior auditor and the company, to determine whether or not there may be some integrity issues with the company. Now, it's the predecessor auditor's job to contact the it's the successor auditor's job to contact the predecessor auditor, and if so, the predecessor auditor, the prior auditor should communicate back whatever needs to be communicated. However, the client must give permission for the prior auditor to be able to communicate with the successor auditor. If the client refuses to allow the prior auditor to talk with the successor, that should raise a lot of red flags. So that would probably be the death knell before even starting the representation. If this is a continuing client, you need to do an annual evaluation of whether or not you want to continue on with this client based upon any issues that may arise between parties, conflicts, potential litigation. Are they worth the fee? Is the trouble of performing the audit worth the fee? And then, of course, there's always the issue of client integrity. If you feel like they're not of high quality integrity, it's probably time to cut them loose. Another thing to do is, if this is a new client especially, I mean, if it's a continuing client, you probably know what the reasons are for the audit, but if this is a new client, find out why they need the audit. Are they a publicly held company? Are they selling the company and they need the audit for that purpose? Are they trying to obtain loans from a particular financial institution? Because that may change your opinion on whether or not you want to accept them as a client, and determine whether or not you want to accept the risk. You know, you have to think beyond the audit client to potential litigants against you. And so that's why you have to look at the likely statement users and the intended uses of the statements, because there's a high likelihood of litigation by the users should something go wrong. You may find that the risk of auditing this firm is just unacceptable. You need to get an understanding or obtain an understanding with the client. Again, this comes through the form of an engagement letter. Again, this is contractual in its terms. It's the agreement between the two parties. And so it should spell out with some particular specificity what the understanding is. And so it should include what the objectives are of the audit, what the responsibilities of the auditor is, what the responsibility of management is. Should talk about the schedules and the fees. And it also needs to have a disclaimer in it that essentially says that the auditor does not guarantee against acts of fraud or material error. So after you understand the client's reasons and you've checked the potential client out and you think they're of high integrity and that you have the expertise to handle the audit and all that stuff, you have to develop and document a preliminary audit strategy that sets the scope, timing, and direction of the audit and that guides the development of the audit plan. And so this preliminary audit strategy should consider the client's business and industry. It should consider whether or not, what material misstatement risk areas there are within the company, the number of client locations, and past effectiveness of controls. This preliminary strategy helps the auditor determine resource requirements and staffing. And so if you have a multinational company, you may have to get audit staff from various offices to coordinate auditing in those locations of this company. One thing you want to try to do is, if this is a new client, and I guess to a certain extent a continuing client, you want to try to maintain staff continuity. You want to try to keep the same audit staff on the audit from one year to the next, to the next, to the next, because that way they don't have to continue to be on the learning curve. Your preliminary strategy will help you in determining whether or not your staff doesn't have the expertise that is needed to do some aspect of the audit. And if so, if they're not expert in a certain area, you might need to consider hiring specialists. Next thing you want to do, once you have accepted the client and performed an initial audit planning, is gain an understanding of the client's business and industry. Now, again, before you take an audit client, you would think that the lead auditor and the audit staff would have some experience in this industry. For instance, let's say they get a new client in the energy industry. Well, even though it's a new client, they are in the energy business, and if the auditor has experience in the energy business, it's not going to take them long to figure out the client's business and industry. If they have no experience in the energy business, number one, you would have to question whether or not they're competent to even handle this audit. So, how do you understand the client's business and industry? Well, several different ways. And so, in recent years, there's been several factors that have increased the importance of understanding the client's business and industry. I mean, if you look at the Enron example at the front of Chapter 8, it kind of gives you a flavor of, well, nobody seemed to know exactly what Enron did. And so, for that reason, their auditors, who are no longer in business, by the way, should have gotten to know more about the Enron business model. So, some of those factors that have occurred are declines in economic conditions. Things just haven't gone well the last 8 or 9 years. Information technology. Auditors need greater knowledge about major customers and suppliers and related risks. Global operations. Customers have expanded through joint ventures and other means, acquisitions and such. And then human capital, the increased importance of human capital and other intangible assets has increased accounting complexity and the importance of management judgments and estimates. And so, under the heading of understanding a client's business and industry are several factors that need to be considered. The industry and external environment, the business operations and processes of the client's management and governance, the client's objectives and strategies, and of course, how they measure performance. And so they talk about 3 primary reasons for obtaining a good understanding of the client's industry and external environment. Number 1, the risks associated with specific industries. The inherent risks common to all clients in certain industries. For instance, in the energy industry, the price of oil and gas. Is an inherent risk of all energy businesses. And then certainly any unique accounting requirements for that particular industry would have to be considered as well and understood. And so the auditor should understand the factors such as major sources of revenue, key customers and suppliers, sources of financing, and information about related parties. And so in order for that to happen, what the auditor needs to do are the following. Tour the plant, tour the offices. This will give the auditor some idea of how the client does such things as safeguard assets and possibly give them some idea of the processes that occur in the business. It can, by observing while you're touring the plant, you can maybe get a flavor for whether or not certain inventories are maybe sitting too long, maybe getting obsolete. It might give you a better understanding of the accounting data related to those assets that you've observed as well. You need to identify related parties because related party transactions need to be treated differently when you're auditing this company. And so a related party is defined as an affiliated company, a principal owner of the client company, or any party with which the client deals where one of the parties can influence the management or operating policies of the other. So, affiliated companies, principal owners of the company, any party with which the client deals, a party who can influence management or client policies. Now, going back to this, auditing standards require that the auditor ask the client who are its related parties. So, and they also need to ask whether or not they've entered into transactions with those affiliated entities as well. I guess that goes without saying, but so identify related parties, identify transactions that have occurred between the related parties. Management and governance. How does the company govern itself? What type of management structure does it have? What are the activities of the board of directors, and what are the activities of the audit committee? And so a lot of this can be found in the minutes, but some other things to look at are the corporate charter and bylaws. That might not tell you a whole heck of a lot because they're usually fairly boilerplate. Whether or not an audit client has a code of ethics might be an indicator of how they govern. If they have a code of ethics, it means, or at least it's an indication that they are of high integrity. Now, it doesn't mean everything. You can still be of low integrity and have a code of ethics, but at least it's some indicator that they have produced this code, created a code, produced it, and hopefully live by it. Notice that under Sarbanes-Oxley, the SEC now requires public companies to disclose whether or not it's adopted a code of ethics that applies to senior management. Next thing you have to look at when trying to understand the client's business and industry is the client's objectives and strategies. And so it says that strategies are approaches followed by the entity to achieve its organizational objectives. And so the auditor needs to understand the client's objectives, And these objectives that they need to understand should be related to financial reporting reliability, effectiveness and efficiency of operations, and compliance with laws and regulations. The next factor in understanding a client's business and industry is measurement and performance. How does the client measure its performance? And so here are some examples. They may measure their performance by how much market share they have in that particular industry. They may measure performance by how much their sales staff sells, each salesman sells, possibly unit sales growth. A couple of others, website visitors may be important to some companies. Same store sales and sales by square foot. And so note that performance measurement includes ratio analysis and benchmarking against key competitors. Now, is that something that the client does, or something that the auditor does? Well, probably the answer there is both. I mean, the way the company indicates its performance measurement is they go out and, let's say, they base it upon market share. They're going to go out and see where they stand in the market. They're also going to, though, with this ratio analysis, compare themselves to other companies in that industry. And so, again, we'll talk here shortly about ratio analysis. Hopefully you've done some of this already, so it shouldn't be a big surprise. So after you understand the client's business and industry, next you move to assessing the client's business risk. And so the client's business risk is the risk that the client will fail to achieve its objectives. And so the primary concern here for the auditor is that if they fail to meet their objectives, possibly material misstatements in the financial statements would occur. And so what you're looking at here is the summary of the relationship among client's business and industry, client business risk, and the auditor's assessment of the risk of material financial misstatements. Not sure that really tells you much of anything. Now remember, under Sarbanes-Oxley, management must certify that it's designed disclosure controls and procedures to ensure that that material information about business risks is made known to them. Management must certify it has informed the auditor and the audit committee of any significant control deficiencies. So, doesn't mean it always happens, but at least under Sarbanes-Oxley, for public companies, management's supposed to affirmatively certify that they've designed controls as well as notified the proper parties if there are any deficiencies. All right, so again, going back to after we assess client business risk, next thing we're going to do is perform preliminary analytical procedures. This is required by the auditing standards, that the auditor in their planning the audit, they must do preliminary analytical procedures. They must do this during the preliminary part of the audit as well as at the end. During the audit, it's up to the auditor whether or not they want to do it. And so some of those preliminary analytical procedures would be comparison of client ratios to industry or competitor benchmarks. And this provides an indication of how the audit client's doing in comparison with others in the industry, either directly or as a whole, as a group. These preliminary tests can reveal unusual changes in ratios as well. And so in the book, we have this table 8-1 that shows this Hilberg company to the industry for a couple of years. And so you've got your different types of ratios: short-term debt-paying ratios, that would be liquidity ratios. Then you have liquidity activity ratios. Down below you have some other ratios, more of a long-term approach there with the third set, and then profitability ratios after that. So here we just have a summary of the parts of the audit planning. And again, the major purpose is to gain an understanding of the client's business. What this is if you look, when you're planning the audit and designing an audit approach, you're setting materiality and assessing acceptable audit risk and inherent risk. You're trying to understand internal control and assess the control risk. You need to gather information to assess fraud risks. And the key is to develop an overall audit strategy and audit program. Now the next thing they talk about is the purposes of analytical procedures and the timing of each procedure. And so they can be performed at any of the three times during an engagement. But at 2 of those 3 times, analytical procedures are required. And so in the planning phase, analytical procedures are required. During the audit itself, it's optional, but often done. And then at the completion phase, analytical procedures are required again. And so this just kind of illustrates that. Now, depending on the purpose of the audit and several other things, you might need to figure out what the most appropriate analytical procedures are for your audit client. And so there are 5 major types. Industry data. This is just comparing averages of companies in the same business. You might compare current year audited with prior period data. You might compare audit results with the client determined expected results. The auditor themselves might have expected results based upon their analysis. And then you might have expected results that you could extrapolate using non-financial data as well. And so again, some of these analytical procedures in the form of ratios you've probably already dealt with in other classes, but just to jog your memory, inventory turnover, gross margin, things like that. What this is internal comparisons and relationships, and so they give some examples here. So looking at the first one, raw material turnover for a manufacturing company. So that's the ratio, and you're comparing this with possible misstatements. And so the possible misstatements with raw material turnover of a manufacturing company is the misstatement of inventory or cost of goods sold, or possibly even obsolescence of raw material inventory. Let's see what else. Going down to the fourth one, bad debt expense divided by net sales. And the possible misstatement there might be a misstatement in the allowance for bad debts. So I think this is just nothing but a few examples of the types of ratios you might look at for possible misstatements. And so here you're comparing client data with similar prior period data, and here you're benchmarking net sales and comparing all the other components of your income statement with net sales. And so as you see in this example, this company has net income in 2014 that's 2.8% of sales, as compared with 2.4% in 2013. So that seems to be a positive step. Again, common financial ratios. You should have had some exposure to this already. you have a certain set of short-term debt paying ability ratios, also called liquidity ratios. You have liquidity activity ratios. They're tied into liquidity, obviously. The third category is how leveraged are you? And so here you're questioning the ability of the company to meet its long-term obligations. And then last but not least, profitability ratios. And so typical liquidity ratios are the cash ratio, quick ratio, current ratio, liquidity activity ratios. Common are accounts receivable turnover, days to collect a receivable, inventory turnover, and days to sell inventory. Debt to equity and times interest earned are two common ratios used to determine the company's ability to meet their long-term debt obligations. And then profitability ratios include earnings per share, gross profit percentage, as well as profit margin. A couple others, return on assets and return on common equity.